Hi, everyone. Thanks for tuning in to another iteration of the Market Pulse. On the call today, you have myself, Bepin Serraj, and Mike. The theme for this week is China Strikes Back, a little bit of an homage to the new AI model that came out over this past weekend. It was a very hectic open to the weekend, or to the new week here. We really saw news coming out of a new AI model from the Chinese. Everyone had assumed that the Chinese would be far behind the US due to the chip ban that we have on them, where they can't get the highest graded chips that we sell. It turns out that is not the case. They have figured out a way to innovate on the older chips. So let's dive into there. The quote of the week this week is everyone has a plan until they get punched in the mouth. Quite a famous one by Iron Mike Tyson, really referring to, for the last 2 years here, we really enjoyed a monopoly on AI. All the AI advancements, developments that you were hearing, think about ChatGPT, think about Llama from Facebook or Meta. That was all from the US. You didn't hear any updates from Europe, and God forbid, nothing from Asia. But that all changed overnight almost over this weekend, where if you were on social media, it was everywhere. DeepSeek this, DeepSeek that. Did the Chinese just have a Sputnik moment? And that brings us to all these headlines we saw over the weekend. On Monday, the NASDAQ 100 dropped about 3%, one of the larger drops that we've seen in years, or actually worst day in 6 weeks from now. But those type of sell-offs really give us an eerie reminder to like 2020 or 2022. So, but one thing to obviously keep in mind is these are very short-lived panics. Like this was all from one AI dropping and hitting the top of the app chart. So it was the top downloaded app over the first week of release. And that really sent shockwaves across the whole industry as people realized that we spent hundreds of billions on creating our AI models and training them. The Chinese just did that for a fraction of the cost. And not only for a fraction of the cost, the performance was as good, if not better, in some of their models. So that really sent the markets in a tizzy, where we saw Monday red across the board. I think Nvidia had about 15% off their market cap knocked off. Obviously, they've been the darling of AI, so any sort of change to the AI narrative, they're the ones that are going to feel it the most. They have started to rebound a bit, but not entirely. Obviously, this is still a fresh wound, let's say. Looking at the chart in front of you right here, this is showing all the different AI models. On the column over to the left here, you're looking at performance. So basically like a test grade, the higher the score, the better the model did on the whatever test that they ran it through, whether it was, I don't know, they use the SAT, all these different standardized tests to have them train on. And on the bottom, you'll see cost, which this is a logarithmic scale, which means that like each distance in between is a 10x. So you see it goes from 10 cents or 100K per unit and onward. Basically, that's a bunch of jargon. Don't focus on that at all. The way to look at this chart is top left means it's cheap and very good. Bottom right means it's very expensive and not that good on the tests. So as you see those two red dots over there from the Chinese DeepSeek, both up and to the left, meaning that they're cheaper than their counterparts and they perform as good, if not better. The reason this title or this slide is called Jevons Paradox, if you're not familiar with what that is, Jevons Paradox basically states that as technology becomes more efficient, you would naturally expect that if it becomes more efficient and cheaper, that means there should be less usage of it. But what actually ends up happening is that as it becomes more efficient, there is actually an increased demand for usage. A good example to think of is, think about ice cream. So let's say ice cream costs about $5 a scoop. And due to magic advancements in ice cream technology, all of a sudden, ice cream now only costs $2.50 a scoop. Are you going to buy more ice cream or less ice cream? I don't know about you or Mike, but my answer would be definitely buy more ice cream, probably even spring for the third scoop. Live a little large, but basically what we're getting at is that AI now should be far more prevalent. Think about places that can't add AI just because of those huge sticker prices on training the model. I mean, we could see AI in TVs, microwaves, fridges. Just as these costs keep coming down, they can add them to even cheaper and cheaper technology. We believe that this will actually be quite a boon for AI, and as particularly NVIDIA and other chip makers. Yes, they won't sell as much as their high-end chips, but they'll sell a heck of a lot more of those second-tier and third-tier chips now that we figured out a way to use them.
Bevin, real quick too. I mean, there's 2 points that I want to jump on this because I mean, I think that that's a great analogy, and I'll use another analogy. I mean, if I remember being a kid in the '80s
Hmm.
and Coke versus Pepsi, right? The Cola Wars, and I remember my dad actually worked for Pepsi at the time, believe it or not. And I remember like we were not allowed to have Coca-Cola products in the household, like nothing. I didn't taste Coke until I probably went to like later on in high school.
I
It
feel
was
bad
a
for you, man.
war. It was a battle, right? And I think I remember one of the things my dad and this became ubiquitous knowledge at some point, but Coke and Pepsi fought each other, and in a very strong way became better. Both companies got better because they had competition, right? So I think it is a Sputnik moment to a certain degree. What's going on here? That's the first
Hmm.
thing, and I do think it's going to make us better. But the second thing I want to point out here, and I think you saw a rebound later on in the week
Hmm.
after that Monday morning sell off, because I think
Yep.
people started to realize that the China is doing one thing that they do better than anything else is lie. There is so
Yep.
I used to work with the number one analyst on Wall Street. His name is Stacy Raskin for this sector. He's a very, very bright guy, and I read some of his research earlier this week, and he basically said there is no way, literally no way, they spend $5 million to train this model. There's no way. Now I don't know
To
how
be
much
fair,
the
they did
money.
caveat it. They said that it
They
only
did
cost
caveat it.
after that we built out, basically they built out they have to build everything from scratch. So they spent a lot of money doing that. But once they figured out the system to train this new model with the amount of chips they used would have cost 5 million. Of course, you can't do that from scratch, but
I think the point here, though, is that we don't know exactly how much it is. They're
yes.
probably
Yep.
lying to some degree, but they're
Hmm.
not. They're probably not like making the whole thing up either, right? But the point here is that
Yeah.
we don't know. We don't have all the information yet, which is
Hmm.
why we're seeing markets kind of react in kind of an erratic manner.
Yep. Yep. And it's not just the cost either. There's a lot of discussion that they may have piggybacked off of OpenAI. So there's a lot. It's a wait and see moment. But if the cost efficiency, if the efficiencies and costs are true, we'd expect that to expand AI usage in society. But
Mm-hmm.
speaking of volatility, like you were addressing there, Mike, this is just a great time to remind everybody that volatility is the toll we pay to invest. If stocks were easy, everybody would be rich. Everybody would just hold 100% stocks. We would just save a little bit of money every month and our money would skyrocket. But the toll we pay for this fantastic growth we do see in the stock market is volatility. There are days where money is erased from your accounts. The dollars you thought were yours are no longer yours, just on a drop of a hat. In this case, a new app launching on the Apple Store. Um, just so everyone's aware that this is completely normal. We expect them every year around 6 to 7, and now that's just an average. So the way averages work is there could be 3% corrections this year. There may be only three, but this is a very normal part of being invested in stocks. So it's not something we'd expect to change going forward. Speaking after DeepSeek, there was the next major event in the market would have been the Fed meeting. Obviously, it wasn't as explosive as past Fed meetings where there's rate cuts or maybe even rate hikes. This one was just another pause. From the commentary we heard from Fed Powell, they do believe rates are restrictive, which means that if you look at this chart below, it's showing you the target rate probabilities for the end of year meeting for the Fed. So this is the last meeting they'd have of the year. So this is basically a gauge to say, where does the market think interest rates will end at the end of the year? Right now, over to the right, I've read in red there, so you can realize how many cuts that is from where we are right now. The I'd say like the distribution centers around 2 cuts right now. For a while there, it was 1 cut or less. So we are seeing the market start to kind of agree with our earlier opinion that we expect more than 1 cut. We'd probably expect 2 to 3, if not more. One of our main reasons for that is there will be a lot of political pressure. That was a big discussion around like the Fed talk after, where Jerome Powell took questions from the media. I think they spent about like 15 minutes grilling him to see if he would give them any insight into how it's going between him and Trump. The breaking headline out of there is that they haven't talked since Trump's been in office. Really kind of setting up the stage for another kind of standoff between the US president and the Federal Reserve chairman. The last time we saw this was around 2019, and we all know who blinked, and it was Jerome Powell. We think that could happen again.
Yeah, speaking of politics, I found I
Drew
found
the
it
short
interesting
straw
because
again, huh?
yeah, it always seems to be the case, but that's okay. I love talking politics. Look, I mean, the Fed is going to do what they are independent theoretically, and I don't necessarily think Powell is in the same position he was in 2019 to some degree. Now, he's going to take on some pressure, but ultimately, we got to ask ourselves what's going to drive inflation going forward, okay? Because that's going to ultimately be the factor, I think, more than anything else, that's going to make the Fed go up or down or left or right. I mean, I think the rate hike is certainly off the table, but if you look at the inflation expectations, I think this is a great example of a huge mistake people can make when thinking about the future. So if you look at, these are inflation expectations by political parties. So look on the right-hand side in that red dotted box. You'll notice right after the election in November of last year, that blue line at the bottom are Democrats. So they asked Democrats, what do you think inflation is going to do over the next 12 months? And as you can see, they expect it's going to skyrocket and take off above 4%, give or take. And then Republicans said the exact opposite. They said, my guy won, my team won.
0%.
It's going down to zero. The world's going to be, healed. So,
Yeah.
it's one of those situations where, okay, that's fine, but that's not how inflation works.
Yeah.
So this is a good example of the fallacy or the mistake that people can make by injecting politics into these decisions. Politics don't drive inflation. Policy does. And policy is very different. And at the end of the day, there's only one thing, in my opinion, that's going to really push inflation up or down going forward. One thing, okay? It's not tariffs. It's, oil certainly will be inflationary up or down, but ultimately widespread rampant inflation up or down has to do with one variable. It is the money supply. We have talked about this so many times in these presentations.
Mm-hmm.
I went back to June, and I found out June of 2020 was the first time I wrote about inflation in a very long time as a warning that inflation was coming. Now, how did I do that? Did I get lucky? Did I look in a crystal ball? No. I just listened to Milton Friedman. Okay.
Yeah.
And basically, he summarized it as inflation is very simple. It's too many dollars chasing too few goods. It's a supply demand imbalance with the currency. That blue line and that red dotted box, that blue line represents the money supply right around the time the Fed decided to inject a bunch of money into the system around all the lockdowns, okay, when we weren't allowed to leave the house, right? Mm-hmm. So over a 40% increase in the money supply in a matter of a couple of months. We have never seen that in the history of our country, not even during World War II. So it wasn't anything other than we increased the supply of money while demand didn't really change. That's the reason why you see that orange line a couple of months later, or maybe a year later, spike as well. Why? Because all that money got injected into the system, and that orange line is widespread, or what we call headline inflation. The money supply caused inflation to spike. So when we hit the brakes, we hit the reverse, whatever you want to call it, the money supply, that blue line, fell down below zero for the first time in modern history, by the way. All right, when money supply was negative, that's what brought widespread inflation down. It is that simple. So going forward, widespread inflation is going to be based off what happens with the money supply to some degree, or the economy grows at a rate that's fast enough to absorb this added money supply that was put into the system. Both of those situations are going to take time to play out. Going back to what Bepin said earlier, what are our expectations about what the Fed does this year? Well, we don't know, but there's a pretty good chance that they'll cut a couple times, but there's no gun to the back saying you got to do it and do it quickly. Conversely, there's nothing pushing them to say, hey, look, you might need to raise them because inflation is getting out of control. The money supply is the key here. Secondary, the rate of economic growth.
Now you get the funnest slide.
Leads us to the elephant in the room. We left it for the end. Is that okay? Well, if that's the case, then what's the future? Let's do first principles. Then what's the case for the money supply, or what's the future for the money supply and or economic growth? Here, let's just focus more on economic growth because that's the easiest one to kind of relate towards. So what does Trump 2.0 mean? Okay, so we've got, 10 days since he's been inaugurated. We haven't seen this much activity from a presidential administration, I don't think ever. Certainly in modern history, but I mean, I'm talking about going back to the 1800s at this point. I don't know because I don't have the data to support that. but I would be surprised if there's anything been this aggressive so far. So there's a couple of things we want to talk through here because they are certainly going to be impactful. So the first is that one of our expectations of going forward, first and foremost, we do think that the tax cuts and the Jobs Act of 2017 will be extended. So the tax cuts that Trump put in place in 2017-ish are going to be, they're not going to get touched. If anything, there's a good chance that they could go down, okay? So I'm not necessarily as concerned about a change in the tax situation. What I would say, though, is that I think a lot of these expectations, and this is Bepin and I guessing here, a lot of these expectations have been baked in and built into the market already. So I think and if you think from a math perspective, push the politics aside for this conversation, okay? If a company earns $1 in earnings, okay, they have $1 that they've made. Now, if the tax rate is 30%, they have to give 30 cents of that dollar to the government, which leaves them 70 cents to go do something with their business, right? Whether it's reinvest back into the business for future growth, maybe pay their employees more, pay dividends to their shareholders. They've got a couple options with that 70 cents. Now, if they lower taxes from 30 cents to 20 cents, that gives the company 80 cents. They got an extra dime, an extra 10 cents. They could do something within the economy, okay? So again, politics aside, the lower the tax rate, the higher the opportunity for economic growth because there's more money to be injected into the economy. It's that simple, okay? So I think that this is a good thing from an economic perspective if they're able to hold taxes where they are or cut them, okay? But when we think about our investment strategies and where we see investment opportunities over the long run, I'm far more concerned with what happens with regulation, okay? Now, regulation, there's a Goldilocks level to regulation. And it's very hard to pinpoint where that's at. But generally speaking, less regulation leads to higher business formation, more entrepreneurship, more innovation, more investment into the future. And that tends to be a good economic outcome. So I think most of the eyes of long-term investors like myself right now, and Bepin, we're looking to see how does regulation change because the regulatory environment in this country over the past couple of years has moved in a direction that has slowed down the future for economic growth, okay? Now that might sound like I'm pro something. I'm not. What I'm saying is that if we can pull back some of the regulatory environment, we could see a massive influx of economic growth that is not just over the next 12 or 18 months, but potentially 3 to 5, maybe even 7 years or even longer. This is where a lot of our eyeballs are on right now. We're just going to have to wait and see what comes out of this administration. Now, that's good, right? That's good for economic growth, theoretically. What's not so great for economic growth is that the U.S. will most certainly continue to run a deficit. Now, the deficit is a tricky subject, but the short version is I don't think Republicans or Democrats, for that matter, have any appetite at all for really tackling the deficit. Now, DOGE is out there targeting $2 trillion in spending cuts in the next 18 months. We'll see if they get there. I hope it's a lot higher than that. But ultimately, the deficit is something that's going to be very hard to tackle given the spending and the money printing that's gone on in the last several years. And I'm not saying just the Biden administration. I'm going on way past that. Okay, now we saw a spike in the Biden administration for all intents and purposes. Republicans and Democrats, since the year 2000 or so, have spent similarly. Now, the deficit, to be clear, the optimal number for the deficit is not zero either, okay? The deficit and regulation are somewhat similar in that there is an optimal level of both, and it's not zero. So we'll have to wait and see there as well. Now, the third, and I think Bepin and I would probably have a longer debate on this if we're time constrained, has to do with tariffs, right? Tariffs are, it's on the one hand, if you ask the, how do you call it? I would
economists,
say the economists, the academics, right?
The academic crowd, yeah.
They're going to say, oh, it's inefficient, deadweight loss, and prices are going to go up on goods like washing machines. And they probably are, right? But I think on the other hand, you got to ask yourself, what are these tariffs really being used for? And I do believe that they are being used more for negotiating tactics than anything else. Look at what happened with Colombia.
That's a great example. Yep.
Yeah, look, they came out and said you can't land your planes here with the Z-14s. Trump says on X, okay, that's fine. We're going to tariff you at 25% on week 1. Week 2, we're going to increase this tariff to 50%. 38 minutes after Trump posted that, the president called Trump and said, okay, never mind. You can land your planes.
Send those planes.
Okay.
Yeah.
Why? Because 28% of Colombia's exports come to the U.S. It would have crippled their economy. So again, whether you agree with that or not, doesn't matter. The point is, I think these tariffs are used for a reason. Furthermore, if you look at these, we talked about this, I think, a couple of weeks ago, the trade deals that we have with other developed countries, this is going back decades as well, has been so one-sided against the U.S. And Trump's goal is to fix that. So there's a little bit of unknown here, okay? But if he's able to renegotiate a lot of the trade deals that we have with our trading partners, there is a possibility that ends up being very advantageous to the U.S. over the long run. Now, could there be short-term inflation on some products? Yeah, there could be, all right? But we talked about this earlier. Widespread inflation, highly, highly unlikely. So drill, baby, drill. Those are not our words, by the way. If you were watching the inauguration, that was all Trump, obviously. So Trump, I'm going to take a step back. The U.S. is the #1 producer of energy in the world, right? In terms of hydrocarbons, natural gas. We've drilled more in the last 6 years than we ever have before. We're exporting a lot of liquefied natural gas, which for those of you who don't know, it's very difficult to transport gas. So what they do is they actually liquefy it and send it to places like Japan that don't have natural resources for natural gas. So point is that we have been drilling, but the Biden administration before he left office tried to basically ban a lot of these projects. Trump's reversing that. The key point here is that the energy situation is actually pretty important, simply because this could be inflationary or deflationary. Okay, and ultimately, this is a bigger question of near-term inflation, and this is a subject we're going to tackle in one of our later market pulses. But ultimately, we're a situation today where if we look out 5 years from now, particularly with AI and a lot of these other innovations, we don't have enough power right now to meet the demand. We just don't, right? So we're not even close. So it's not a question of hydrocarbons versus clean energy anymore, or anything like that. We need it all, and we need it fast. So if there's any opportunity to increase the supply of energy, not just for us, but for the rest of the world, this should have a positive global economic impact to some degree. And at the end of the day, even if you disagree with a lot of what we are talking about here, just remember one key fact that is grounded in hard historical data, indisputable data. The market has grown under both parties, whether you love Trump or you hate him, whether you love Biden or you hate his administration, okay? The fact is, if you go back in time over the last 80 or so years, all those red and blue bars that you're seeing on the screen are all different administrations. And you're seeing way more up bars than down bars, way more. And furthermore, most administrations had at least one down year along the way, or 2 down years. So the point being here is that the U.S. economy, is a massive machine. These politicians and their administrations, they're the referees. They're on the field setting the rules, calling the fouls, but they're not moving the score. They're not moving the ball forward. Those are entrepreneurs, innovators, businesses, and consumers. And ultimately, what we're trying to do here is look for ways to invest in new technologies, new innovations, new consumer trends that are recession resistant to a degree and somewhat immune to some of the risks that we're seeing out there. And we try to complement that with investing in a lot of these new technologies that we're going to talk about over the next couple of weeks that we see are opportunities. And it will be that I'll steal Trump's line, the new golden age that we're entering into right now.
Yep.
That is effectively what is happening right now. And it's something that we've never seen before. But that's a whole other subject that we'll dive into at a later date.
Thanks for giving them a spoiler, Mike. Just kidding.
But you gotta put a little teaser.
I know you gotta tease them. I know it's the attention grabber. Get them ready for next week.
Yeah.
And with that, we would like to thank you all for tuning in. Like Mike said, we should be back in a couple weeks. Yeah, I even gave you a little bit of a teaser on what's coming next, but we look forward to hearing from you. And take care. Enjoy the rest of your week, and we will see you in a couple weeks. Thanks, everyone.